All right, so I'm going to go through the four grand kingdoms of macroeconomics. When I was in Atlanta, I was at Robinson Humphrey for almost a decade. I was an institutional equity salesman. I moved here, ran sales and trading for a company called Avondale Partners, which is now largely defunct. After that, I went to work for the great Arthur Laffer, who developed the Laffer Curve. You've all heard of the Laffer Curve, and I worked for him for 5 great years as his right-hand man. We dove into macroeconomics, and I was once a stock picker, and then I became a macroeconomics guy under Laffer. So that's what I've been doing ever since. By the way, I travel the country giving speeches on this topic now. I write for Forbes. I write for the Wall Street Journal, CityWire, which is an industry rag, Financial Times. I'm on TV Monday nights, One American News Network. You might have heard of the Graham Ledger Show on Monday nights for One American News. You can find me at 7 p.m. Central, just going through riffing on the economy and so forth. So I'm going to go through Arthur Laffer's four grand kingdoms of macroeconomics, and I'm going to set up the framework for what the economy looked like prior to COVID, and then what's changed and what we might be left with, which is absolutely horrifying. So I'm going to go through my little, hope this works, everybody. First, I want to describe what we've been doing in Nashville during quarantine. That's what we've been doing. That's for Arthur too. All right, we're going to go through fiscal policy. And real quickly, we're going to breeze through the Tax Cuts and Jobs Act, which was, of course, Donald Trump's legislative achievement. It did a lot for the common worker, actually, the low-wage worker. In fact, it benefited the lowest quartile of wage earner more than any other wage cohort. In fact, our average hourly wages were up almost 5% coming into the COVID, year over year. By the way, the most in 35 years, just to let you know. Very powerful trickle-down effect to the Tax Cuts and Jobs Act, and it benefited the low-wage worker, of which there are many, 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 and they are consumers, not savers. So if they get, excuse me, I'm adjusting my screen. If they get $1 in increased wages, they spend it. So it was very good for the economy. This was the consumer economy that was doing great until COVID hit. This is the median annual wage growth, and you can see the lowest 25% bottom quartile had the largest wage gains. So don't let anyone ever tell you that the Laffer curve doesn't work, that cutting tax rates on producers, which are people that run companies, isn't going to benefit the worker and the non-owner. It absolutely does, and it did it again. I'm going to run through real quick one of the other. So that was the fiscal policy, the four grand kingdoms: fiscal, trade, regulatory, and monetary policy. I should have explained that. Now we're going to go into regulatory policy. Donald Trump is a deregulator. He has passed these. This chart is of, or bar chart is of, regulatory actions of over $100 million in consequence. You can see he passed about half of what George W. Bush passed, and about less than maybe 40% of what Obama passed. You can also see where Trump's deregulatory effort has saved the economy about $23 billion. This comes from the Office of Information and Regulatory Affairs in Washington. Let's just say the economic setup at Christmas time coming into January to 2020 was very favorable, again, with the wage gains by the lowest 25% of wage earners, and then the deregulatory effect. The economy was doing really well. Then trade policy was becoming somewhat of a risk. Tariffs interrupt the free flow of goods and services. Trade to China collapses from the trade war. This is pre-COVID. And now you have something much more worrisome, and that is a backlash against China. This is just anti-China sentiment in the U.S. And by the way, it's just as great as it is in Europe. It's even more so in Europe. It's more intense. And so China has been tremendously valuable to the United States in regard to lower prices of goods. As you know, China became a very efficient manufacturing center for the entire world. You can envision China as being just one giant factory servicing the entire world. Incidentally, after 2008 and 2009, the Chinese government made huge investments in infrastructure and developed the most elegant logistics system the planet has ever known. So you couple an efficient manufacturing system with a elegant, like I said, an elegant logistics system, and China trade was optimized. And by the way, Walmart and Amazon on our end was optimizing for the distribution of those products into the U.S. It doesn't get better for prices. Very disinflationary, if you will, deflationary. Okay, so I'm worried about China because some of this trade is going to be diverted. I spoke recently with the head of the AAEI, American Association of Exporters and Importers in Washington, and this lady, the director, predicted that 25% of manufacturing might leave China. So that means we're going to have higher prices going forward. It's very worrisome. One of the things I worry about. I'm really worried in the monetary policy realm. Again, the four grand kingdoms are monetary, fiscal, trade, and regulatory policy. It's through all these four kingdoms that all policy is expressed. And so that's how we look at the world when we look at a lot of investment ideas. Anyway, monetary policy, we are obviously facing unprecedented global central bank activity. I would argue that the bull market of the post-2008, 2009 housing crisis was driven exclusively by Federal Reserve policy. You can see here where every time the purple line is the S&P, every time the S&P fell meaningfully, the Federal Reserve stepped in to bail it out ever since 2008. And these acronyms, you know, they've got about 20 acronyms of these Federal Reserve programs where they're buying debt and so forth, treasuries. And so you can see every time, again, the purple line falls appreciably, the Fed jumps in with a bailout. So I would argue that the 10-year bull market under Barack Obama, post-09 to recently, was built on the Federal Reserve. In fact, GDP growth was about 1.5% that whole time, which is well subpar, and yet the stock market was up 300%. Last year alone, 2019, the S&P earnings did not grow at all. There was zero S&P earnings growth, and yet the stock market was up 30% or 28.5%. Oh, 5 stocks were 70% of that move. So it was a very sketchy market built, in my opinion, on the Federal Reserve's numerous money printing programs, from zero interest rates to Operation Twist to QE, QE1, 2, and 3, where they bought billions of dollars of treasury bonds and bloated the Fed's balance sheet. Oh, by the way, 60% of NASDAQ companies had junk bond rated debt coming into the COVID crisis. A record, by the way, a record not only in the number of companies, but the aggregate amount of debt. I want to tell you that the whole system was infused and engorged with debt that was basically provided by the Federal Reserve's zero interest rate policy and bond buying in QE 1, 2, 3, and so forth. Easy money. It also led to a loosening of credit standards. Covenant-light loans, as you know, have little recourse for the lender and are no different really than no-doc loans, housing loans back in 2006 and 7, when people didn't even have to show proof that they were working to get a loan. So anyway, covenant-light share of loans outstandings was at an all-time high coming in to the COVID crisis. So once again, I described for you a system engorged with debt and loose credit. This is the Fed's balance sheet now, and these are the various acronyms that I mentioned to you and the various programs. The COVID crisis is the black line there, and you can see how it is swelling to unprecedented levels. U.S. government debt refinancing, they've got to actually refinance $11 trillion now, much more debt in the next several years, 5 years. The term structure, this is the term structure of federal government debt. It's all piled up in the next 5 years. We don't have any long-term debt, as you probably know. They've got to issue treasury debt at the auction to pay these obligations. There are no buyers, or there will be no buyers, except the Fed. Here's the budget deficit projection post-COVID. You can see on the right the text. CBO projects that we're going to have a $3.7 trillion budget deficit in the fiscal year 2020, They project it'll be a measly 2.1 trillion next year. By the way, the prior record federal government budget deficit was 1.5 trillion set in 2009. So this 3.7 trillion is well over double that. It's a record. It's a double the record, and it is in uncharted territory. This is QE4, which is what been embarked on recently post-COVID. The orange line shows QE4. This is just central bank purchases of treasuries. They basically go to money center banks with newly printed money and they buy treasuries, injecting capital, new money into the capital markets. That money very quickly ends up in assets by way of the money center banks. It's the conduit. That's why over the last decade, the S&P has risen 300%, and why I think in 2019, I showed you that the S&P rose 30% is because of all of this money printing. And you can see where it is now off the charts with QE4. It's unprecedented by a mile. Nobody knows how it's going to end. The smartest people in our culture are the 800 PhDs at the Federal Reserve. And I think that they are probably making a huge mistake. This is just another view of the balance sheet. What's amazing about this is if you look back at 07, you'll see the balance sheet, Federal Reserve balance sheet was only $1 trillion, only. Then in 09, they increased it to 2 trillion. Then QE1, 2, and 3 started. They increased the balance sheet to over 4 trillion in 2013, 14, 15. And then they were trying to shrink it, you can see. And now, of course, it's off to the races. And they say that the Fed's balance sheet is going to soon be anywhere between $8 and $10 trillion. Again, unprecedented, not just by $1 or $2, but by double or triple. It's just astonishing. I'm going to get a sip of water while you gaze at this. $24 trillion of Treasury debt outstanding. And you could see how small and minute it was and humble this chart was back in 2008. And then, of course, this is federal government debt, treasury, outstanding in the form of Treasury bonds. Now I'm going to go to my idea. Let me go back to this. I think that the setup now is, well, first off, the Federal Reserve and the Treasury are in uncharted territory. They're going to be issuing a record number of Treasury securities to pay the current operations of the federal government, the debt, which is now 3.7 trillion, as I showed you, and probably growing. And the amount of Treasury issuance is likely going to overwhelm demand like it already did in 2019. And the Federal Reserve is actually going to have to buy that debt. So come August, September, October, November, December of next year, at the weekly federal Treasury auctions, the Fed's going to be the buyer. So whatever increase in the Fed's balance sheet that we've seen lately is going to increase, I think, substantially through those weekly Treasury auctions. There's a big movement out there called MMT, the modern monetary theory. You probably have heard of it. We were laughing at this a few years ago. It was a strange progressive notion coming out of Princeton's economic department. Now it's made it mainstream. The idea, take the MMT to its farthest extreme, and they're basically they think, or the theory is that you can, or the federal government, the Federal Reserve can print money almost endlessly and pay directly for stuff. They can pay debt down, or they could pay for infrastructure spending directly without it being inflationary. So let's pretend that the Treasury remains the conduit and that they would just continue to buy Treasury debt as it was issued to fund the current operations of the government. Let's pretend the Federal Reserve just becomes that buyer, which they are currently, by the way, and that's what they're going to do in the future. Think about the amount of money printing that is going to have to happen, the new dollars that are being printed. This is almost like if I was a CEO and you all were my board members and senior officers, and I came to you and I said that, look, I've mismanaged the company. We have too much debt. We've got this downturn. We can't pay it. We're screwed. I can't service my debt. But I've found a way around it, and I'm going to, I want y'all to keep this to yourselves, but it's a way out, and I'm going to do it. I've already decided to do it. I've got a friend who's a counterfeiter, and I'm going to take new money and pay down that old debt with some counterfeit money. That is my view of what the Federal Reserve is doing through their money printing. So people always ask me, what do you own? What do you own? And, hard assets and maybe emerging markets if the dollar gets weak. I think land and real estate and commodities. These are the things that tend to do well in a period of mammoth money printing. I think the Fed is going to see to it that we get inflation. It's going to be like pushing on a rope. It has been. It may continue to be. But I think the setup for inflation is real right now, right here. And I'm going to go through it. First, Milton Friedman's view, and then I'm going to take Q&A. Milton Friedman's view of inflation is too much money chasing too few goods. We've had too much money since 2009 through all the money printing. I showed you those charts, okay? But we've not had too few goods. The amount of goods and services available to us has been abundant, and so that part of the equation has been missing. So when I went into the part about China and the fact that we may see 25% of production leave China, that's going to lead to higher prices, by the way, because that manufacturing capacity is actually redundant. China's optimized to produce things for us. If we have to go find another source of production or another location, it literally is redundant. It will lead to higher prices. This COVID crisis has led to a decline in goods. They're slaughtering apparently hundreds of thousands of head of swine right now. They've got so much oil they can't do anything with it. They're taking it off the market. They apparently are killing chickens. They're also mothballing airplanes. There are 115 U.S.-based airline companies. I didn't know there were that many until I looked into it. Many of them are going bankrupt right now, right here, and they're mothballing their airplanes in the desert, which means you take the fuel out of the tank and replace it with this jelly stuff, and then you drain all the valves and pipes and tubes, and this thing. When you take a plane out of service and you mothball it, it's very expensive to bring it out into service again. So the price of airline seats is probably going to go up. Oh, by the way, they're paying people not to work. In most states, a person that has been laid off from the COVID crisis is making more money than they would be making on their jobs. And that means we're paying people not to work. And by the way, that is going to continue. Right now, I think that lasts up until September with state and federal programs together. It's the deadline. I bet they expand it. I would not be surprised to see them do it 99 weeks like they did under Obama. I can't guarantee it, but they're paying people not to work. So when I talk about mothballing airplanes, okay, killing chickens and hogs, livestock, taking it out of the food supply, and mothballing workers. Suddenly you've got too much money chasing too few goods, perhaps. And I just think that the Fed's going to continue printing money until they see inflation, which means they're going to use the heavy, heavy hand of monetary policy to do that. They're going to be buying treasury bonds in the fall. Remember, I said that at the weekly auctions. The setup for inflation is bigger than it's been probably in my lifetime, or at least, since the 70s. And it's the one thing nobody's talking about. Everyone will tell you it's not possible. Everyone will tell you that prices are falling. Prices are falling. They have to. We'll see. Looks to me like the too few goods is potentially a situation here that's evolving. So be ready for it. And one way that you can be ready for it is through precious metals. I am not a gold bug, but I have come upon this trade in the last year, and I have studied it, how gold and silver behave in periods like this, and it's unbelievably strong. After the 70s, after the Depression, after 87, after 2001, after 2008, during those financial meltdowns, gold and silver outperformed the equity markets by hundreds of percent. After 2008, it took gold to increase 300%, about 2 years. And it took the equity markets 8 years to increase 300%. So I think we're set up for that. How do I play it? Gold and silver have been, gold especially is at $1,700 something an ounce. I think it'll be $2,000 by the end of the year minimum, by the way. The setup's too good. Oh, by the way, we're not the only central bank going bananas. Japan is too. Oh, and the Central Bank of Europe, ECB, they have negative interest rates. This earth has gone bonkers, and central banks have gone rogue. So gold and silver are going to hang in there. By the way, I will tell you that, well, let me go to this chart. Central bank buying of gold set a new high in 2019. It escalated substantially. These are foreign central banks: China, Germany, Poland, lots of third world countries, lots of first world countries are picking up their purchases of gold, by the way, at the expense of treasuries. Their treasury ownership is declining fairly substantially. Excuse me, vodka. So this is very interesting. I like to have a bunch of central banks buying when I'm buying. This is gold to monetary base ratio. It's a goofy chart I pulled off of Twitter. But point is, you saw the monetary base, or you know that the monetary base has increased many, many fold as the Fed has, bought all those treasuries in QE1, QE2, QE3, now QE4. That increases the monetary base. If you compare an ounce of gold to the monetary base, you'll see that it's going to be $5,100 an ounce. I'm not calling for that, but I wouldn't be surprised. I would not be surprised. And by the way, we got an election coming up. There's no telling what happens. Who knows? We might be doing the Green New Deal. We might be giving people a universal basic income funded directly by new money printed by the Fed. What do you do then? I think that the miners are more attractive, but this is, and I'll go through that. This is silver versus the S&P. I did this quickly today. Well, by the way, I manage a portfolio, a hedge fund. I am a partner in a wealth management business, Trustco Advisors. And I also run separate accounts in the commodity space. And so I have a day job. I pulled this together, and it's silver. SLV is an ETF versus the S&P. And you can see there 2009, look at 2008, 9 through 11. The black chart is SLV, and the blue one is S&P. You can see where they both went down together initially in the 08 housing crisis, and then silver got a bid prior to the S&P bottoming and kind of started catching up to itself, and then breaks out to a high and literally increases about from the bottom almost 300% in 2 years. And again, it took the S&P 8 years to achieve that. The best way to play it, I believe, though, is in the miners. The miners, there's no industry group that I can find that is putting up 30% revenue growth and earnings growth, has very little debt to speak of, and is trading at 5 times cash flow. And the whole entire precious metals mining sector is showing some of the most attractive risk-reward aspects, valuation metrics, and then growth metrics. They're going to have explosive revenues and earnings growth. And the simple reason is this: gold this time last year was like at $1,200 an ounce. Now it's $1,700 an ounce. That $500 an ounce difference all falls to the bottom line. They're going to have 70% margins. These are pharmaceutical industry level margins. And they don't have to do anything except keep digging it out of the ground. They don't have to send their workers home. Well, there are a few mines have been shut by COVID, by the way, so I'm not going to go there. But anyway, so that's my idea. I framed why I liked it. I told you what I'm scared about, which is China trade, inflation, and the Fed. And I'm going to take questions. I'm Tom Landstreet, BSer, Chief BSer. I did this for you, for Party Artie. And I'm founder of N3L Capital and Trustco. And you can find me, you can Google my name at Forbes and find a bunch of ideas that I share with the general public. Does anybody have any questions? Come on, I can read your questions if you have one. So in the meantime, I'm going to tell a story about an economist, since that's what I do for a living. He's a Vanderbilt trained atheist, a professed atheist economist from Vanderbilt, who was hiking on the Appalachian Trail one beautiful spring day, just like today, meandering along the forest by himself, deep in his own thoughts, like like economists always are. And he heard a rustling in the woods, and a bear comes out of the woods. And of course, he ran as fast as he could down the path. And the bear was in hot pursuit. Professor looked over his shoulder. Bear was about to catch him. He tripped right then on a stump, fell to the ground, scuttled over to his back, and the atheist college professor was there to encounter a bear with his claws fully extended, about to take his head off. And the atheist professor yelled, "Oh my God!" And the bear froze and time stood still. And a voice came from the heavens that said, "Ha ha 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 ha. Ha ha. You're an atheist professor from Vanderbilt, and you've been telling thousands of students I don't exist, and here under duress, you want help from me. You're calling for me to come to your aid. That's very funny, if not ironic." And the professor said, "Well, God, gosh, I guess it would be insincere for me to ask you to turn me into a Christian. So would you turn the bear into a Christian?" God said, "Very well." The bear reanimated, put its paws together and said, "Bless this food I'm about to receive." Okay, now that you're laughing so hard, somebody asked me a question. Party Artie, are you there? Come on. Oh, questions. Now let me see if I can activate it. Yikes. Oh, here. Hey, can you help me, Fax? Oh, Lordy. Give me a minute. Hang on. I got to get to these questions. Hey, excuse me 1 minute. I'm yelling for my production assistant to come here. And it is my fabulous son.
All right.
I can't get the Q&A set up. Do you know if I have to do stop share?
No.
Oh, here they are. I got them. I did it. The first question is, how much to get rid of a male escort? Asking for a friend. If anybody was at the beginning when I told the story about oil, you must be howling. You may probably already know who that is. How would you get exposure to the gold miners? GDX or GDXJ? Yes, both. Here's how it's going to work. People are going to be more interested in gold, I think bullion first, and physical. And then they're going to go into the bigger ETFs, GDX and then GDXJ. And however, when you're buying the GDX, you're paying up for these stocks because it's market cap weighted. So Newmont and Barrick are trading at 9 times cash flow. But the junior miners, some of them are trading at 5 times cash flow. And by the way, they have production coming online. Barrick and Newmont don't. And I predict that Barrick and Newmont will be making acquisitions of the small miners in order to add to their production, especially if gold stays at 17 to 100 an ounce or moves up higher. And I'm telling you, I think it's going to be higher by the end of the year. 2000 is my conservative target. So yeah, I think you go, first go, I would always have exposure, by the way, to the physical. And I wouldn't buy an ETF like GLD. I think I would go with a physical backed ETF like PSLV, which is the Sprott Silver ETF, or PHYS, the Sprott Gold ETF. These are both backed by physical that are held at a bank. And it literally is 1 for 1, and they're very safe. Some of these commodity ETFs are coming apart at the seams. You might have read about the USO the other day. Unbelievable. There's more shit going to hit the fan with the USO in the next month, actually. So that's, I hope that answers your question about getting exposure. Junior miners, we manage portfolios, by the way, for people that want access with a curated group of, say, 30 stocks. Next question, how much debt will the world allow us to have before they start to devalue the dollar? The dollar is basically judged relative to other currencies. It's a relative game. Everybody's devaluing. The dollar will go down, there's no doubt, relative to gold. And by the way, with treasuries, 10-year treasuries yielding 0.5%, the dollar's already devalued. The dollar has no yield, and there's going to be more pressure on people to reach for yield. It's very crazy environment. It'll drive the price of gold up. It's a small market, a narrow market with a 4,000-year history of being a a currency that's not a promissory note. Think about a dollar. It says promissory note on it. That's a debt instrument. Okay. Any prediction for the commercial banking sector? Regulators are very accommodating now, and everyone has a 90-day extension. How long can this last? We will see widespread failures. Banks, no. I think the Fed will always bail them out. Really, I'm worried more about non-bank institutions. If you look at, for instance, junk bond issuance, which was extreme, of course, since 2017, you'll find that the majority of the buyers of that debt, if not all of it, was from non-bank financial institutions. These are private equity funds that started debt buying businesses, BDCs. There's hedge funds, specialty funds that have been buying all this paper. Bank balance sheets are actually not that bad. You're right that they're going to have to. I do worry about this in June, July. They're going to have to market some of these loans that this questioner is asking about. The regulators are very accommodating now, having a 90-day extension. After that 90 days, what's going to happen to the balance sheet when you have to write those loans down? That is very, very worrisome. There was way, way too much debt in the system. It's infused in not only the arteries, the veins, but the capillaries of the economy. And so when that debt reverses, the bubble all the way out to the capillaries is going to recede. And that is going to be painful. The banks are in better, as I understand it, I'm no specialist, they're in better situation than they were during the crisis of 08, by the way. They say European banks are in very bad shape, by the way. All right, more questions. Where will China manufacturing go? Onshore, India, both, and Mexico. Mexico is the primary beneficiary of Chinese outsourcing, in my opinion. But there will be some come back to the U.S. And if I were the government right this minute, I would basically make it easier for those companies to come back here. I would do whatever's necessary. I would lower the price of hiring people. I might try to get rid of the minimum wage. I would do something, anything to lower the cost of hiring. By the way, on the China story, you can't blame China. You can't blame U.S. corporations either, really. I blame the U.S. government and its regulatory apparatus for making it so costly to hire a U.S. worker that you literally chase companies off of out of a familiar territory, their own land, their own tongue, with their own culture, to a faraway land with a faraway culture, with a faraway religion, with a far distant language. We push them there. That's my problem with this whole thing. So if Trump mandates that these people come back, that'll probably be bad. But if he incentivizes them, that'll probably be good. Apologies if you mentioned this, but on the commodities front, what do you see as the future demand for oil? And should I empty my pool? And you empty your pool. I own tanker stocks, and they are volatile. But I own a bunch of tanker stocks, and I bought them right when I saw this happening. Oil, there's so much of it. There's always been too much of it. Not too much, plentiful, abundance. There's no peak oil, never has been. It was a bogus theory. You can go Google Thomas Landstreet on Forbes and go read what I wrote about it. I predicted $20 oil years ago. And probably 2014 or 15, I predicted that. Well, it hit it. In my world, you can be right, but be early. And it really isn't that helpful, by the way. It's funny. People were patting my back about my oil call, and I hardly even remembered making it because it was, 5 years ago, 6 years ago. Anyway, so much water under the bridge. Oil, I think it's got to go to, probably, I think we're going to shut down production in the United States because it's painful. Okay, I own the tankers, STNG, the tickers are STNG, EURN. I've forgotten them. I've forgotten the other ones. Those are my favorites. And oil. I think that it's going to be going up because they're going to be pulling off supply. I think there's going to be bankruptcies all through Texas. I think that Saudi Arabia cannot withstand ultra cheap oil. They've got so much of it. It's cheaper than any place on earth, but they've got a giant welfare program there. Everybody lives like royalty off of oil royalties. Pardon the double entendre, but that's the truth. They have a giant population used to caviar, and they can't. They'll risk the royal families, sovereignty or position, which they're going to do anything to protect. Which means they're going to have to raise prices some point. And Russia is a one-trick pony. All they have is oil and a few extra minerals. That's it. No economy. They're coming apart. They're terrible, and this can't last. So $40 oil might be the opportunity. I think we're going to get another decline in oil, and it could be below zero again. I'm telling you. Call me or email me, and I'll go through that story with you. It's too much here. Do I miss the Lions Club? Yes, I miss Atlanta. My wife and I both do. She went to Marist, and so I married a native girl. Anyway, and what is the largest company you predict might go bankrupt? Well, the Fed's not going to allow any bankruptcies. Nobody is going to go bankrupt. Well, okay, I'll take that back. I'm being facetious. Ford could go bankrupt. But again, they're going to be bailed out. So there will be millions, thousands of bankruptcies, but they're going to be the smaller companies. That's the deal. Amazon down 4% on earnings today. Opinion? It's overvalued. 5 stocks made up 70% of the S&P's 28.5% move last year. 5 stocks. That's what I would call an unhealthy dispersion of returns. And I knew we had something set up that was a disaster by that and the amount of debt in the system. I don't know if I'd buy Amazon here. It's just too expensive and it's too narrow a market. I don't think this downturn's over. I could see I got to ask you guys. We're all professionals, and I'm in this business, so I think it's all I do really. But when I look out June, July, August, September, let's look at September. What's going to be like? Will the economy be back? Well, I know that the federal government's going to be issuing treasuries like never before, and the Fed's going to be buying those, so I could count on that. I think the economy will be back somewhat. I think the food supply will have recovered. I don't think the number of airplane seats will be as high. I think the the government's going to make a decision to keep people on unemployment longer. I think that there's going to be a hell of a lot of bad news in the interim. A lot of bad news in the economy. And so I'm not really that bullish. I think this market rally is 100% driven by the Federal Reserve. Listen, they stepped in with $1 trillion, and then I'll let you go after this. They stepped in with $1 trillion in buying power in the debt markets in 1 week and spent it all, over $1 trillion. So let's pretend that all of us on this call are the sum total of the debt markets. Okay, we represent all the participants of the debt market, and we are doing business as usual every day, buying and selling and shorting and this and that. And then here comes a new entrant into the market with $1 trillion of new money he's anxious to spend today. He's anxious to deploy his trillion this damn week. How do we respond? I guarantee you we start buying. We know he's got to deploy it quickly. We know he's anxious to deploy it. He's got 1 week and he's got $1 trillion because he told us. We go long. And that's what happened. So that's why we've had this wild rally. It's not unlike the rally in 08 or the Great Depression. I'm not saying we're going there. The Fed's not going to let it. The Fed's going to go berserk. They're gone rogue. We don't know the outcome, but that's why I like gold and silver. It's killing me. All right. Any other questions? Yes, one more. Do we retest the low? No, I don't believe so. I don't believe we retest the low, and I think the Fed will buy the whole. They're going to pass a rule allowing the Fed, by the way, to buy equities. They do in Japan. Did you realize that the Bank of Japan owns 50% of the Nikkei? Did you know that our own Fed bought ETFs recently of junk bond debt? HYG is the ticker, and BKLN. They stepped into our world. I'm surprised they didn't go through Robinhood like the rest of the millennial crowd. They literally have stepped into these markets. If we see a down tick, Pete, like the violent move down, they'll buy equities. They're going to own half the damn capital markets, like Japan. I'm actually predicting that. They're going to own a lot of our economy. What if we have a bad election in November? Okay. And Lee Haverstock smells like a cabbage. That's not a question. That's a comment. I didn't make it. I'm reflecting the sentiments of 1, 2, 3, 4 people said that almost at the same time. What's going on here? Um, okay, gang, I've had a good time with you all. I'm speaking to my own image, by the way, hoping that you are laughing and enjoying this or learning and so forth. I miss you all. When I come down there, can I come to a Lions Club meeting? Can I give you a speech in person with my chart someday? If you want to do anything, if you want to contact me, feel free to do it. And somebody's raised their hand. What does that mean? Oh, Arthur Sinkler thinks I have a lot of books. All right, that's it. I think that's all my questions. Any more? I bid you adieu. You're great people. Thank you for listening. And you can contact me anytime you want for anything. That's what I promise. Bye.